Hi, everybody. Today we are going to look at the stock market historical returns over the last 100 years. And the reason I want to look at the 100-year performance of the stock market is because I'd like to look at volatility in the stock market and what that means for investors who are putting their most of their savings into the stock market. Of course, there's a lot of different considerations. There are definitely ways to do better in the stock market rather than worse. But let's just look at the overall stock market. We all know that it goes up and down. So the first thing we're going to do is we're going to type in stock market graph Dow Jones. And then we are going to scroll down to macrotrends.net. And I like to use macro trends for stock market research. They have a lot of great searchable data. And then we're going to scroll down, and here we are at the Dow Jones, and we'll scroll down so we can see the years. So the Dow Jones is just one index. I definitely encourage you to look at other indexes, which you can look at on macro trends yourself. But let's just start with looking at something we can all relate to, probably if we're alive, is the dot-com boom and bust and what that did to the stock market. So it's 1999, 90s, the economy is going gangbusters. It peaks in 1999, and then the bubble pops and it goes down, 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 down until 2002, and it starts to recover. It's kind of sluggish, and it does start to recover. In 2007, we recover. We get to about the same level as we were in 1999. Then, as we know, there was another crash, and the stock market goes down, 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 down. And that was the Great Recession, which we did not recover to the same level, at least the Dow Jones didn't, until 2013. So if you think about it, that's if you invested your life savings in 1999, then they would have dropped, and then they would not have recovered until 2013. So basically, there was no, if you had invested in the Dow Jones, there would have been no gains for 13 years. And that's a long time to be socking money away into your 401k and not earn any money on it. So that's not the first time that happened. It also, if you look, we'll just quickly talk about, here's 1966. It doesn't actually recover until around 1995. And here's the Great Depression, peaks in around 29, and then doesn't recover until about 1960. So another 30-year recovery. Of course, there's a lot of different ways to look at this. Another thing I want to point out is that this crash in 2007 was caused by the US subprime mortgage crisis. And one thing that I would like to say about that is that the single family home market was hit much more than other recession resistant asset classes, which is what I like to focus on. It's one of the reasons why I like multifamily, I like self-storage, I like mobile home parks, and there are several other asset classes which tend to perform well during downturns. And this is why that's so very important. You want to invest in an asset class that will weather the downturns better, because if it doesn't, it could take years, sometimes decades, to recover. So another thing that I want to point out is just talking about personality. So one of the reasons why I don't like to put my money into the stock market is because I don't actually like the ups and downs of the stock market. It just doesn't suit my personality. And another reason is that I actually like, if you look at the data, if you take a data-driven approach, then it can be very hard to justify putting a large portion of your income into the stock market. Now, I know a lot of people do that. That's very common in today's world, but it's important to know that there are other options out there. You can put your investments into investments that have more predictable returns. They might not have the huge ups and downs that the stock market has, and then you'll miss out on the emotional highs of when the stock market is doing really well. But you'll also potentially have greater peace. That's why I like to do it anyways. So I like to invest in deals that I think they're not without risk, but they are have risk. They have strong returns on a risk-adjusted basis, and it's just harder to achieve that in the stock market because, as one investor said to me, you just can't win in the stock market every year. So I hope you keep that in mind. I hope you learned something. Feel free to do your own research. I'd love to hear what you come up with. Thank you so much and have a great day.